Am I audible?
Yes, sir, you're audible. We'll wait for 5 more minutes, sir. We'll start.
Okay.
Good evening, everyone. Welcome to Ministry Education Program. Today we are going to discuss on introduction to commodity derivatives market. So we have here Mr. Rohit Raj from SEBI, who's Assistant General Manager at SEBI. So you can please take over the presentation.
Good evening. Welcome everyone to this presentation on commodity derivative market. In this presentation, we will discuss regulatory framework for commodity derivative market, uh, the various participants of commodity derivative market, what are the benefits for participants for commodity derivatives trading, and the various products which are available in commodity derivative market. Our country financial system is comprised of four different pillars. With SEBI is responsible for regulation of security market. Banking sector is looked after RBI. Insurance sector is looked after by IRDA, while pension is looked after by PFRDA. Earlier, commodity derivatives was looked by a separate regulator, FNC. Then in 2015, central government decided to merge SEBI and Forward Market Commission. Since then, commodity derivative market is looked after by SEBI. Uh, Basic powers of SEBI were defined under SEBI Act 1992. The main mandate of SEBI is to protect the investors, to regulate the security market, then to promote the development of security market. Our regulatory system is comprised of two tiers. In first level, there are stock exchanges and clearing corporations, which frame rules as per regulations of SEBI. Then SEBI frames the rule as per power given to it by central government. Central government has notified 91 goods on which commodity derivative for commodity derivative tradings. The various commodity exchanges can introduce or commodity derivative contract only among those 91 goods. Of those 91, 41 are being traded. Then commodity derivative contract which are traded on exchange, their their value is derived from the price in the underlying spot market. For example, if cotton is traded on commodity exchange, then price of cotton in the spot market influences the price in derivative market and vice versa. To undertake start trading in commodity derivative market, a trader has to open trading account with a SEBI registered broker. It has to open a bank account. If it is under, it has to open ENWR account. Then only it can start trading in commodity derivative market. And these are some key terms for commodity derivative. Final settlement price is the uh, final price at which the contracts are settled at the expiry of contract. It is determined by taking average of spot prices in the last 3 days before expiry. Then in commodity derivatives, every day market settlement is done, which is difference between the which is determined by difference between daily closing prices, and then staggered delivery is there. Most of the commodity derivative contract are settled by compulsory delivery. Then buyers and sellers have option to take delivery of product in the staggered period also before the expiry of contract. So generally it is 5 days for MCX and 7 days for NCDEX. During that period, uh, sell, buyer and seller can submit intention for taking delivery. Then we have NCDEX and MCX have launched commodity index contract, which uh, which are index of prices of underlying commodity future contracts. They allow investors to take positions in a basket of commodities without uh, undertaking physical settlement. There are three type of deliveries. Uh, Most of the contracts are settled by compulsory delivery at expiry. For example, in cotton, so at expiry, whoever is the seller who is holding open position at expiry of contract, he has to deliver the goods, and whoever was the buyer holding open position at the expiry has to take the delivery for settlement. Then there is intention matching. In that type of contracts, buyer and seller are allowed to submit intention for taking or giving delivery of goods only to the extent to which intention matches between buyer and seller. Only for those contracts physical delivery is done. For the remaining contracts where intention has not been matched, contracts are settled by cash. Then the third method is seller option. In that case, seller has a option to choose between cash settlement or giving physical delivery. In that case, to the extent which a seller had delivered intention, buyer have to take delivery of goods. Commodity derivative market is much different from equity derivative market. Main difference is at the end of contract in most of commodity derivative contract, buyer has to take physical delivery of goods. Then the underlying for any type of commodity, lot of variations is there. So commodity derivative exchanges uh, specify beforehand the standard to which the goods have to meet for giving delivery before giving delivery. While in equity derivative market, such a problem do not arise because the stocks are very standardized. Then in commodity derivative market, the underlying market is very fragmented and price discovery is often difficult. That's why SEBI has framed several regulations for discovery of the final settlement price by polling of spot prices. But this problem do not happen in equity derivative markets. Then in a commodity derivative market, because it is very fragmented and for some of the commodity, the market is very illiquid. So price can be very volatile. Sometimes government frame regulation increasing or changing taxation methods or introducing new import or export duty. So commodity derivative market price can be very much more volatile than in stock market, which are only driven in the market perception of value of the stock price. Then commodity derivative market, currently the market for commodity derivatives remains much lower than equity derivative because SEBI is trying to increase the market participation in commodity derivative market. The two biggest commodity derivative exchange are NCDEX and Multi Commodity Exchange MCX. In NCDEX, most of the commodities belong to agricultural sector, and MCX, most of the commodities belong to this metal or energy sector. BSE and NSE has also in the past 2 years has launched some commodity contract, but their volume in commodity segment remain much lower than in MCX and NCDEX. While Indian Commodity Exchange is an old exchange, but its volumes has declined very significantly. And these are some of the commodities which are being traded in commodity derivative market. India is one of the biggest producers of agricultural goods. So bearing in mind, uh, commodity derivative contracts in lot of agricultural products has been launched in India, including this jeera, kapas, maize, raw jute, paper, moong, paddy. Similarly, in non-agri commodity also, in most of the non-agri commodity belong to metal sector. The crude oil contracts are settled by cash. There is no physical delivery for crude oil and natural gas. Diamond is only traded in ICX. So most of the volumes are in metal segment and in gold and silver. Currently, there are many misconceptions about trading in commodity derivative market, which discourages people from trading in it. That it is dominated by speculators or it is prone to manipulation. But SEBI has introduced several measures to discourage speculation and speculative behaviors, we, which will be detailed in the next slide. Uh, some of which are we have introduced position limits to discourage uh, speculation and gambling. Then SEBI is constantly checking price margin and price volatility in commodity derivative market. We have also framed regulation for assuring quality of delivery, and SEBI is trying to frame regulations for encouraging retail investors to participate in commodity derivative market. We have waived regulatory fees to promote participation by farmer producer organization in commodity derivative market. So there are several categories of investors which are trading in commodity derivative market. Several companies which have exposure in commodity derivatives, they are undertaking trades to hedge their exposure and their trades contracts for trades. So various importers, exporters, and are trading in commodity derivative market. For example, in gold sector, Titan Titan it trades in Indian commodity derivative market to hedge its exposure to price of gold. Then various brokers trade in commodity derivative market. Day traders, market makers, and several mutual funds and large investors also trade in commodity derivative market. Then for efficient price discovery, also arbitrators and market makers are trading in commodity derivative market. They try to make profit by exploiting price anomalies, but they also help in reducing anomalies in price of market. Then these are the three main pillars of commodity derivative ecosystem. Repositories, they are repositories, clearing corporation, and stock exchanges. Trading of commodity derivatives happens on stock exchanges, while clearing and settlement happens on clearing corporations. Then additional stakeholders are these warehouse service providers, WDRA, warehouse development regulatory agencies, quality assayers and testing labs, which test goods before their delivery, price polling agencies are which are used to poll spot prices for determining final settlement prices. Then Indian government or has allowed farmer or producer organizations, a kind of cooperative organization which several farmers can become a member. Such farmer producer organization can trade in commodity derivative market on the behalf of their members. In there are several benefits of commodity derivative trading. This helps in the price discovery. This allows better price discovery between various underlying spot market and with international market. Then this price risk mitigation, commodity derivative market allow people to hedge their price risk in commodities. Then trading on commodity derivative exchange eliminates counterparty credit risk. People can trade on exchanges being sure that when they make the payment, their goods will be delivered to them. Then standardization of products. This ensures that when anyone is buying in commodity derivative market, that they have a assurance of standard of delivery. So for assurance of these measures, while framing contracts, several key features are defined in the contract. We have stock exchanges and clearing corporation specify the basis center, the city on which price of commodity is used for polling of spot prices or determining final settlement price. Then the quality to which quality specification for goods which can be delivered for that contract, trading unit and delivery unit. They have to specify the unit of trading. Then additional delivery centers. These are the additional cities on which delivery of products can be undertaken. Then timing of commencement of trading. Uh, Contracts in contract it is specified what is the time duration which trading can take place. Then various risk parameters are also specified. There are limits on open position. Any speculator cannot undertake corner the market and take very large position compared to market. Then we have daily price limits to limit the volatility in price of contracts. SEBI has specified various type of margins, initial margins, pre-expiry margins. These are specified beforehand in the contract. Then how final settlement price is calculated. This is also specified beforehand in the contract specification. Then price discovery in commodity derivative market have, helps farmer to reduce dominance of commission agent and middleman and encourages their bargaining power. They now have a market to which they can negotiate. No one can cheat them that the price of product in international market or in other places is much different. Now they can look at price in commodity derivative exchange and know the fair price of product. Then this allows farmers to hedge their price risk. If, therefore, SEBI is encouraging participation by farmer producer organization. If more farmers can participate in commodity derivative market, they could hedge their price. This can even sometimes what happens when there is a bumper crop, price of the crop falls very drastically, so they can hedge their price risk. Not every commodity is suitable for commodity derivative trading. So SEBI has specified some parameters which are checked before recommending the commodity for derivative market trading. We look at the size of the global markets. The commodity having large global market, large import exports are more suitable for commodity derivative trading. Then we'll look at price control in commodities. If price of in commodity is highly regulated, then there cannot be price discovery in commodity derivative exchange. Then we look at volatility with international market. What is correlation of prices in Indian market with international market? Who are the various participants of value chain of that commodity in Indian market? And what are the various Indian laws which are applicable? And commodities having a larger seasonality can benefit more from commodity derivative market as it will enable farmers to hedge their price risk in lean season. Then durable and geographical coverage of commodity is also considered, and how much price is volatile of that commodity. Then there are two main type of commodity derivative products. First is futures. Here there is a standardized contract. If a farmer buys a future contract, then he can hedge his price risk. Even if but even if price goes up, then he will make a profit. But if price goes down, he will make a loss. Then the other type of contract is option contract, where the buyer of option has the right but not obligation. So if price moves in a favorable direction, the farmer will benefit from buying the option. But if there is a adverse price movement, the loss to farmer is limited to the premium of the option product. And there are two types of option products: option in good and option in commodity futures. In option in goods, at expiry, the buyer of option has to take the physical delivery of goods. In option of commodity futures, after expiry, the option products buyer of option receives the corresponding future contract. In most of commodity derivative contract, physical delivery is mandatory. So SEBI has framed several regulations for warehouse service provider. Warehouse service provider has to ensure the safekeeping of the goods. They have to The warehouse must be registered with WDRA, and warehouse service provider has to register with the clearing corporation. For undertaking deposit in warehouse, first seller has to take the delivery of goods as per contract specification. Then it has to book online warehouse spaces. Then it has to deposit good in exchange group warehouses where quality testing of deposited goods is undertaken. After quality testing, electronic negotiable warehouse receipt is generated, which the seller can deposit in clearing corporation and fulfill its delivery obligation. Clearing corporation undertakes counterparty risk, so it becomes seller to every buyer and buyer to every seller. If a buyer or seller defaults, clearing corporation under full ensures there is no loss to non-defaulting buyer or seller. To ensure that clearing corporations are able to manage default risk, they are SEBI's framed several rules for clearing corporation. Clearing corporation has to maintain adequate funds to them to handle risk of default by buyer or sellers. Clearing corporations do not directly interact with the clients. Clearing corporations have clearing members associated with them, and clients trade through trading and clearing members. Then clearing members undertake clearing and settlement through clearing corporations. And clearing of funds is undertaken through clearing banks. Then there is settlement process. Difference between settlement process of cash and futures and options. In settlement for futures, only price difference of future is settled, while in option only the premium is settled. On on expiry, options contract is settled through delivery of goods if it is option in goods, or it is through delivery of futures if it is option on commodity futures. In futures for contract with compulsory delivery, settlement is undertaken through delivery of underlying commodity. And SEBI has introduced several initiatives for developing commodity derivative market. We have in 2017 introduced option in commodity futures as underlying. These options on commodity futures have similar risk management as futures. And warehousing norms on commodity derivatives were revised. Then we have also permitted in 2019 futures on commodity indices. These allow investors to take position in several commodity together. Then in 2020, we introduced option in goods. These allow investors to undertake physical delivery of goods at expiry of option. Then we have also reduce the staggered delivery period from 10 days to 2 days, 5 days. And we have permitted mutual funds category to AIF eligible foreign entities and portfolio managers in commodity derivatives. Then SEBI has mandated two funds, Investor Protection Fund and Investor Service Fund, for benefit of commodity derivative market. Investor Service Fund is used to provide basic infrastructure facilities to Investor Service Center set up by stock exchange, while the Investor Protection Fund is used to safeguard interests of investors and clients in case of default of members. Then SEBI has a online advanced redressal mechanism called scores, where anyone has who has a grievance with the intermediary or exchange, they first have to approach that intermediary or exchange. If they are not satisfied the resolution provided by intermediary, they can launch complaint on Scores portal. Then it is given the process for registering on Scores. Any person can register on Scores and file a complaint. So for safe investing in a commodity derivative market, a person should only trade for SEBI registered member and always be compliant with KYC norms. They should not share their internet trading account password with anyone. Then they should register their mobile number and email address with stockbroker and insist on periodical statement of accounts from broker. For safety, they should not delay payment or delivery of commodities to member, and they should not issue check in name of authorized person. Then SEBI also itself has a website where people can approach for knowledge about commodity derivative markets and various rules which have been framed by SEBI. Then we have various toll-free helpline and various local and regional offices where people can approach for guidance or grievances. Thank you.
Uh, Thanks for the presentation, sir. If anybody is having any doubts, you can please ask. I hope nobody is having any doubt. Thanks for the presentation, sir. We'll end the presentation.
Okay. Thank you everybody for participating.